Today we're doing a complete breakdown of ASC 450. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine a company facing a lawsuit that could cost millions, yet no trace of it in their financial statements. ASC 450 changed that scene, ensuring contingent liabilities are disclosed, offering transparency. You'll soon grasp how it reshaped financial reporting by compelling companies to acknowledge uncertain obligations. ASC 450 was designed to tackle the issue of undisclosed contingencies in financial statements. Prior to its implementation, companies could mask significant potential liabilities. By introducing consistent disclosure criteria, ASC 450 ensures investors and stakeholders are aware of potential financial obligations, safeguarding against misleading financial reports. Companies must now assess the probability and estimate potential losses, promoting transparency. ASC 450 applies to all entities adhering to US generally accepted accounting principles, ensuring uniformity in reporting contingencies. Effective since December 15, 1975, it marked a new era in transparency. Companies must disclose possible liabilities by assessing their likelihood: probable, reasonably possible, or remote. This evaluation guides what needs to be disclosed, enabling investors to make informed decisions based on potential financial impacts. The contingency recognition model is central to ASC 450. It mandates that entities recognize a liability if it's probable and the loss can be reasonably estimated. This approach prevents financial misstatements by ensuring potential liabilities are accounted for. Understanding how to apply this model is crucial for interview success, showcasing your ability to identify and manage potential financial risks. Understanding what ASC 450 covers is critical, especially when candidates often forget that remote contingencies aren't included. That's a classic interview trap. Knowing what is and isn't covered can save businesses from financial misstatements and help you ace those interview questions. ASC 450's scope is precise, highlighting areas like litigation-related loss contingencies and contingent liabilities from guarantees. For instance, a lawsuit could result in a significant payout, which must be carefully evaluated. Environmental liabilities, such as pollution cleanup costs, and uncertain product warranties are also within its framework. Properly applying these can prevent financial misstatements and ensure compliance. Exclusions often trip up candidates. ASC 450 doesn't address remote contingencies that can't be estimated. Contingencies tied to future events not deemed probable are outside its realm. Sales commitments often confuse applicants, but remember they don't fall under ASC 450. Contractual obligations without uncertainty don't make it into the standard either. Understanding these exclusions is key to mastering the scope. A contingency reflects an existing condition or situation with uncertain outcomes, potentially leading to gain or loss. Take pending lawsuits as an example. They represent contingencies that require careful evaluation. These situations could significantly impact financial statements if not correctly accounted for, emphasizing the need for precise assessment under ASC 450. Understanding contingencies ensures accurate and reliable financial reporting. Probable events, those likely to occur, are crucial in ASC 450. When likelihood exceeds 50%, financial statements must account for them. For instance, if a company anticipates settling a lawsuit, it's deemed probable and requires recognition. Ignoring probable events leads to inaccurate financial records, underscoring why understanding this definition is vital for compliance and sound financial reporting. Edge cases often test the boundaries of ASC 450's scope. Consider a lawsuit with unknown damages. It falls within the standard if probability and estimation criteria are met. What about guarantees where default seems unlikely, or environmental cleanup without legal mandates? These scenarios challenge interpretation. Lastly, verbal commitments for customer refunds might seem like contingencies, but require clear assessment under ASC 450. Navigating these nuances is key for accuracy. Imagine facing a lawsuit that could cost millions. Without ASC 450's contingency recognition model, companies might mislead investors about true financial risks. This cornerstone of ASC ensures that potential liabilities are not hidden, but recognized or disclosed, providing transparency and trust in financial reporting. The contingency recognition model is vital for capturing potential financial risks. We'll track Meridian Corporation's $10 million SaaS contract with Acme Incorporated. This agreement includes $8 million for a software license and $2 million for implementation services. Each step of the model helps us understand whether and how to account for potential losses. It ensures financial statements reflect possible liabilities accurately, safeguarding investor trust and decision-making. The first step involves identifying any event that could lead to a financial loss. Meridian Corporation's $10 million contract with Acme Incorporated could face risks like software bugs or delays. Ignoring potential indirect impacts, such as customer dissatisfaction, is a common oversight. ASC demands consideration of all possible risk factors, ensuring no stone is unturned. By pinpointing these contingencies, companies can prepare for financial implications that might arise from seemingly unlikely scenarios. After identifying potential risks, assess how likely they are to occur. Meridian Corporation must determine if issues with their $10 million SaaS deal are probable based on historical data. Many candidates mistakenly categorize reasonably possible risks as improbable, ignoring ASC's emphasis on careful review. By evaluating past incidents and current project conditions, companies can better gauge the probability, ensuring they recognize contingencies that merit attention in financial reports. A probable rating directly affects financial statement entries. Determining the potential loss amount is crucial. For Meridian Corporation's $10 million deal, focus on how delays could affect the $2 million implementation fee. Many underestimate losses by ignoring possible worst-case outcomes. ASC requires you to consider a range of scenarios, anchoring on the most likely amount. This ensures financial statements reflect realistic potential impacts, guiding stakeholders with accurate information on financial exposure. The loss estimate feeds directly into recognition or disclosure decisions. Recognizing a contingency means placing it formally in the financials. For Meridian Corporation, if their SaaS contract risks are probable and a $1 million loss is estimable, it must be recorded. Many shy away from recognition due to estimation uncertainties, yet ASC mandates inclusion when both criteria are met. This step ensures stakeholders see potential impacts clearly, transforming earlier uncertainty into clear financial implications. The recognized amount informs stakeholders of potential financial shifts. Disclosure in financial notes is essential for contingencies not recognized, but still reasonably possible. Meridian Corporation should detail potential $1 million losses if uncertainties prevent recognition. Often, companies omit these disclosures, missing ASC's full transparency requirement. By sharing these details, stakeholders understand potential financial impacts beyond what's recorded. This step ensures even non-recognized risks are visible, maintaining trust and allowing informed decision-making regarding the company's financial health. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 450 guides how contingencies are measured and disclosed, ensuring your financials reflect reality. Understand the criteria for recognition and what must be disclosed to avoid misleading investors. Recognition of contingencies under ASC 450 requires a careful evaluation of probability and estimability. If a lawsuit is probable to result in a $1 million loss, that amount should be recognized when the financial statements are prepared. This ensures liabilities are not understated, presenting a fair view of financial obligations. Subsequent measurement under ASC 450 involves ongoing evaluation. If additional information suggests a previously estimated $500,000 liability is now $700,000, adjustments should be made immediately. This dynamic process ensures financial statements remain accurate over time, reflecting real-time adjustments based on the latest data and assumptions. Presentation is key for clarity. A $2 million liability due next year appears under current liabilities, while notes should explain the related lawsuit's nature. ASC 450 requires these details to guide stakeholders in understanding potential impacts on future cash flows and profits, ensuring informed decision-making. Disclosures provide essential context. A pending $3 million environmental cleanup should be detailed with potential impacts and expected resolution timelines. Explaining measurements like using industry benchmarks strengthens credibility. These disclosures help users assess the financial health and risk exposure, promoting trust and facilitating investment decisions. Imagine the CFO of a tech company dealing with a major $5 million lawsuit. Initially recognized as a liability, it later increases to $6 million after new developments. Properly adjusting the books and providing detailed disclosures ensures investors understand the associated risks and potential cash flow impacts, maintaining transparency and trust. Meridian Corporation, a global manufacturing company, is facing a pending lawsuit potentially costing $1,500,000. Let's uncover how ASC 450 guides the accounting treatment of this contingent liability. Watch how Meridian Corporation recognizes, measures, and reports the financial impacts of this event. ASC 450 requires recognition of a contingent liability when a loss is probable and can be reasonably estimated. Meridian Corporation's legal team advised that the $1,500,000 lawsuit is likely to result in a loss. Consequently, the company recognizes this potential expense in its financial statements, ensuring transparency and compliance. With new insights, the legal team reassesses the likely loss at $1 million. ASC 450 mandates adjusting the recognized liability to mirror the most current estimates. Meridian Corporation reduces the liability by $500,000, enhancing financial statement accuracy and reflecting the revised expectation of loss. As legal proceedings continue, Meridian Corporation anticipates $200,000 in additional legal fees. ASC 450 guides the accrual of these anticipated costs as an expense. This ensures the financial statements reflect all expected future cash outflows related to the legal matter, maintaining comprehensive liability reporting. Meridian Corporation settles a portion of the lawsuit for $500,000, reducing the liability on its balance sheet. ASC 450 ensures that the financial statements reflect this disbursement accurately. This entry lowers both the cash and the liability, signaling progress towards resolving the legal matter. Following partial settlement, Meridian Corporation's legal counsel reassesses the remaining liability at $400,000. ASC 450 dictates adjustment based on current information, resulting in a $100,000 reduction. This adjustment not only affects the liability, but also recognizes a gain, improving the net income. Meridian Corporation finalizes the lawsuit settlement by paying $400,000, eliminating the remaining liability. ASC 450 ensures that the financial records accurately close out this obligation. The company's balance sheet now reflects the complete resolution, with cash reduced and liability zeroed out, marking the end of this legal journey. Upon concluding the legal proceedings, Meridian Corporation recognizes $50,000 of the legal fee reserve as unneeded. ASC 450 guides the reversal, reducing the liability and the associated expense. This adjustment fine-tunes the financial statements, ensuring that only actual incurred costs impact the income statement, providing a precise view of expenses. Every Big Four and investment bank interview on ASC 450 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. ASC 450 deals with accounting for contingencies. It exists to ensure consistent recognition of uncertain liabilities and assets. Loss contingencies are recognized if probable and estimable, ensuring financial statements reflect potential liabilities. Avoid confusing loss and gain criteria. Gain contingencies are not recognized until realized. Memorize probable and estimable for losses. ASC 450 requires recognition of loss contingencies to ensure liabilities are not understated. If a loss is probable and the amount can be reasonably estimated, it must be recorded. This prevents misleading financial statements. A common trap is ignoring remote contingencies. Remember, probable, estimable, and disclosed. While ASC 450, Indian Accounting Standard, and International Financial Reporting Standards all deal with contingencies, Indian accounting standard does not explicitly differentiate between probable and remote like ASC 450. International Financial Reporting Standards uses virtually certain for recognition, more conservative than probable. Memorize. Probability threshold differs. Avoid assuming uniform standards across frameworks. Remote contingencies are not recognized under ASC 450 as they are unlikely to occur. This prevents overstating liabilities. However, they must be disclosed if there's a chance they could impact decision-making. A common error is failing to disclose such items. Remember, disclose even if remote. A company records a probable loss by recognizing it in financial statements and disclosing its nature. The amount should be reasonably estimated. If a range is given, use the low end. Avoid underestimating. Remember, estimate and disclose probable losses. This ensures accuracy and transparency in reporting. Gain contingencies are not recognized until realized to prevent premature income reporting. This contrasts with loss contingencies, which are recognized if probable. The reasoning is conservatism in accounting. Avoid early recognition. Key takeaway: realized, not anticipated gains. This ensures financial integrity and aligns with conservative principles. Debit the expense for the estimated loss and credit a liability. This aligns with recognizing probable and estimable losses, ensuring liabilities are portrayed accurately. Remember to include disclosure notes. A common mistake is omitting disclosure. Key takeaway: debit expense, credit liability, disclose. This reflects financial reality accurately. Environmental liabilities are generally covered under ASC 450 if they meet the contingency criteria, probable and estimable. Misunderstanding this scope can lead to non-disclosure, a frequent mistake. Remember, probable environmental obligations must be disclosed and recognized. This ensures compliance and accurate financial reporting. A CFO must disclose the nature, timing, and amount of contingencies, even those not recognized. This provides transparency and informs stakeholders. Failing to disclose non-recognized contingencies is a trap. Key takeaway: comprehensive disclosure of all contingencies ensures transparency. It supports informed decision-making by stakeholders. ASC 450 revolves around ensuring that entities recognize and disclose loss contingencies consistently. The standard applies to all entities under US generally accepted accounting principles, except those with insurance contracts. It defines contingencies as potential obligations based on past events, resolved through future events. Key terms include probable, indicating a high likelihood, and reasonably possible, suggesting a moderate chance. Importantly, only material contingencies impacting financial positions need disclosure. The ASC 450 model demands recognizing a loss when it's probable and can be reasonably estimated. For estimation, choose the best estimate within a range, or the minimum if unknown. Gain contingencies, however, are only recognized when realized, but disclosed if probable. Discount future cash flows when the time value of money matters. Disclose details of loss contingencies and consider subsequent events impacting recognition or disclosure, covering legal, warranty, and environmental issues. In interviews, watch out for confusing probability thresholds for recognizing and disclosing contingencies under ASC 450. Unlike international financial reporting standards, US generally accepted accounting principles has a lower threshold for recognizing provisions. Disclosing is necessary for reasonably possible contingencies. Legal exposures can be tricky. Ensure accurate estimates. Interviews often focus on using the most likely amount in range estimates. Materiality is subjective, impacting disclosure, and understanding the effect of subsequent events on recognition is vital. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.